Hey guys, welcome back. So I know it's been a few weeks since I put out an episode, but I'm actually currently in the progress of transitioning into a new role. For those of you who are interested, the new role is going to be in corporate development, M&A. But that's not the purpose of the episode today. In today's episode, I'm going to be breaking down 5 exciting growth stocks that are down from their earnings later last week that Ark Invest have been buying. Now, of course, Ark Invest have been buying a whole bunch of different stocks in the past week. However, the stocks I'm going to be covering today are stocks that are not only on my watch list, but also are down from the earnings report. So in no particular order, the first stock is going to be Pinterest, ticker symbol PINS. So as a quick background, Pinterest is a virtual discovery engine for finding ideas like recipes, home and style inspiration, and more. Pinterest is an American image sharing and social media service designed to enable saving and discovering of information on the internet using images and, on a smaller scale, animated GIFs and videos in the form of pinboards. Now on Tuesday, March 27th, shares of Pinterest were pummeled as shares fell about 15%. Now the financial numbers were actually pretty strong, but the management provided fairly low and perhaps too conservative guidance for user growth. Now the simplistic narrative would be that the numbers were great, but growth is slowing down, so the stock deserves a lower valuation. That would make sense in theory. I don't think it actually accurately describes the future. Pinterest looks well positioned to delivering vigorous revenue growth and expanding margins in the years ahead. If the business does well, the stock price should follow. Now, if you want to know the main reason why Pinterest is down so much after the report, then you should look no further than the user growth numbers. The company ended the quarter with 478 million users, a year-over-year increase of around 30%. The number was slightly below market expectations, but nothing to be too concerned about. International markets are clearly the main growth engine for the company in terms of users nowadays. However, user growth guidance was a big disappointment in the report. Management is expecting monthly active users to grow within the mid-teens next quarter, and user growth in the US to be expected to be around flat on a year-to-year basis. The main driver behind this modest user growth guidance is that the management considers that the pandemic has pulled forward some of the longer-term user growth in recent months. After the reopening gained steam in the second half of March, management observed deceleration in user growth, especially in the US, where the company has had a larger user base and the low-hanging fruit has already been captured. Management said that engagement levels from users gained in 2020 remained strong in the first quarter of 2021, but it also clarified that it has a limited understanding of how engagement levels will evolve in the future. Now, there's also a very interesting positive in the numbers, since the company observed particular strength coming from users under age 25, a persistent trend that we've seen for many quarters. Gen Z pinners tend to be also more engaged than older users. From a demographic perspective, it's clearly exciting to see Pinterest gaining strength among younger generations. Growth was already decelerating in the company's biggest markets due to the natural maturation of the business. The pandemic pulled forward some of that user growth, and now there will be a deceleration after the reopening. Both the pandemic-led acceleration and the subsequent deceleration after the reopening are transitory by nature though. The main thing to consider is that Pinterest has already reached a massive scale, which is crucial in order to capitalize on the network effect and also attract enough advertisers to the platform. That battle has already been won, and Pinterest has lots of levers to pull in order to drive strong revenue growth from its existing large user base. Now, user growth is slowing down, even if some of the slowdown is temporary because of the unwinding of the pull forward created by the pandemic. It's also widely anticipated by the market though, especially after the most recent earning report. On the other hand, the best days are still ahead of Pinterest when looking at the value of the platform and the potential of the business. Revenue reached $485 million last quarter, growing by 78% year over year, and representing an acceleration versus prior quarters. Now, what's even more impressive to me is that management is expecting revenue growth to be 105% in the second quarter of 2021. So despite the company expecting user growth to be in the mid-teens, its revenue growth is over 100%, which obviously implies a massive acceleration in monetization. Now, the important thing to note is that the average revenue per user increased 50% in the US and 91% in international markets last quarter. International revenue per user is still minuscule in comparison to the US, with it being 26 cents versus $3.99. And Pinterest is just starting to take its first steps regarding this international monetization. Now, on the surface, it appears that Pinterest's best days are ahead of them, as they get majority of their revenue from the US, and the monthly active users are starting to slow down. However, I think the key differentiator between Pinterest and other social media platforms is that Pinterest doesn't need this MAU number to continue to grow exponentially. Instead, if they focus on their monetization efforts and build out their platform from being more of a social media platform into a social e-commerce platform, they can leverage their existing user base to increase the average revenue per user, which acts as a growth driver for them long into the future. Ad impressions were slightly down year over year, both in the US and internationally. However, the increase in monetization is being driven by more engagement and better performance as opposed to showing more ads. In other words, Pinterest is increasing monetization without hurting the user experience at all. Shopping can be a huge driver for a visual platform like Pinterest, and the comments from management are quite encouraging. The number of users engaging with shopping services in Pinterest grew over 200% in the past year, and initial data is indicating that post-COVID shopping engagement could be more resilient than overall engagement. Recently, on April 21st, Pinterest announced an expansion of its alliance with Shopify to bring social commerce to 27 new countries. More than 1.7 million Shopify merchants around the world can bring their product to Pinterest and turn them into a shoppable product pins that are discoverable across the Pinterest platform. Advertising in international markets is also growing very strongly, and it reached around 20% of total revenue for the first time ever last quarter. Pinterest also has recently launched advertising in its first Latin American country, Brazil, and it has plans to launch ads in Mexico in May. These initiatives show how much room Pinterest still has in order to continue expanding monetization and revenue growth over the years ahead. Now, another standout in this report was that Pinterest is performing pretty well in its profitability. The company still has a long way to go before reaching its full profitability potential, but expenses are growing at a slower rate than revenue, so profit margins are expanding at a pretty strong rate. The adjusted cost of revenue was 27% of revenue last quarter, which was down from 36% in the year-ago quarter. The business model allows for abundant profitability once reinvestments start to slow down in comparison to revenue growth. Pinterest is barely scratching the tip of the iceberg regarding profit potential, but the business is clearly moving in the right direction with its profitability of this current quarter. Pinterest is still producing outstanding revenue growth, and the opportunities for sustained improvements in engagement and monetization are very exciting, both on their advertising and e-commerce front. Next up on the list, we have Teledoc Health, ticker symbol TDOC. Now, Teledoc Health is a virtual healthcare company that provides virtual telehealth services to patients all across the world. The company was founded back in 2002 as Teledoc Inc. and is generally hailed as the first of its kind in the US and the largest player in the space today. They have services in roughly 130 countries and serve more than 50 million people. Their business model has been slowly built over nearly 2 decades, long before the company's IPO in 2015. And while the company has been public for years, the real strength of the business model hasn't necessarily peaked until recently, following the company's $18.5 billion merger with Livongo to create the entity that it is today. Now, despite a revenue beat with its Q2 2020 financials, Teledoc Health fell around 10% after EPS data fell short of expectations. Not only that, but their guide for total visits in 2021 were estimated only around 20% year-on-year growth, as opposed to the 150% growth recorded in 2020. Now, their first quarter revenue increased 151% year-on-year to $453 million, driven by 56% year-on-year growth in total visits, which stood at 3.2 million. At its core, telehealth is about digitally connecting patients with healthcare solutions that they need. By itself, telehealth isn't necessarily too much of a moat or a competitive advantage business model. Scale is the largest advantage, and while Teledoc is a huge player, it still faces competition from multiple players, including American Well Corporation, which is Google-backed, Doctor On Demand, and others. With the telehealth becoming increasingly available to patients, the current state of the industry is being in a phase where this infrastructure is just hitting the stride. The increase in connectivity has been useful during the COVID pandemic, and we are seeing a digital transformation of the existing healthcare industry. Some expect this digital migration is only a temporary thing, and it may very well recede once COVID passes. However, the opportunity in Teledoc is not just about the digital transformation of existing healthcare, but the emergence of new means of providing healthcare altogether. Teledoc represents an interesting opportunity as an innovative disruptor in one of the largest, most lucrative, and inefficient industries of the modern world, healthcare. The Livongo acquisition was really a game changer for Teledoc, and Teledoc's large network will be able to grow and expand the reach of this new whole person health ecosystem. Branding Teledoc as a COVID play that will simply retreat once COVID goes away is a mistake. Teledoc was trending up before COVID, and the economic and technological advances of this technology will likely bring much needed efficiency to healthcare over the long term. I think Teledoc will play a big role in that over the years to come. Next, we have Spotify, ticker symbol SPOT. Shares of Spotify fell around 12% last Wednesday after the streaming music and podcast company released its first quarter earning report. Now, Spotify's revenue climbed 16% year over year to $2.6 billion. Its free cash flow, meanwhile, improved to nearly $50 million compared to the negative $25 million in the year-ago period. The gains were fueled by a 21% rise in premium subscribers to 158 million. Many people have turned to digital forms of entertainment while cooped up at home during the pandemic. Podcast and streaming music providers, in turn, have enjoyed increased demand for their services. However, Spotify is facing intense competition from larger rivals with Apple and Amazon. This likely weighed on Spotify's active user growth during the quarter, and although its monthly active users rose 24% to 356 million, this closely watched figure was below the 360 million that Wallstreet was expecting. Spotify also lowered its full-year forecast for active users to between 402 million and 422 million, down from a prior estimate of 407 to 427. The reduced growth outlook comes despite the company's heavy content investments. Spotify reportedly paid more than $100 million to lure popular podcast host Joe Rogan in signing an exclusive deal back in May. Now, Spotify continues to really innovate and try out new concepts. It recently acquired Betty Labs to accelerate its entry into the live audio space. It also announced a partnership with Facebook to allow social users to listen to Spotify music without switching applications. Now, Spotify also started raising prices in select markets in the fourth quarter last year. It expanded on those early prices increases in February with hikes in 25 more markets, and once again earlier this week with increases in key markets like the US, UK, and Brazil. Raising prices, particularly for its multi-user plans, is a big point of leverage for the streaming company, which has seen its average revenue per user decline considerably over the last few years. There may be an opportunity for Spotify to expand gross margins by increasing prices. Certain expenses like payment processing and content delivery have fixed costs that don't change based on Spotify's pricing. More importantly, there may also be some leverage in Spotify's contracts with music labels. Now, the early results in Spotify's price increases have been pretty positive, and investors should look for ARPU to start trending towards growth in the second half of the year. Gross margin expansion could follow as the company renegotiates its deals with its record labels. The next stock that's down on its earnings that Ark Invest has been buying is, of course, Tesla, ticker symbol TSLA. So we all know about Tesla, but let's talk about their most recent quarterly results and where Tesla is positioned moving forward. After the bell on last Monday, we received the first quarter results from the EV maker Tesla. With the stock having traded sideways this year after massive rally in 2020, the street was looking for solid results and a major production update to get shares going again. Unfortunately, it was another quarter where overall results didn't impress, which sent the shares lower. By receiving regulatory credits and holding Bitcoin, Tesla was able to offset the losses of its core business, which expands every quarter and continues to show profitability on its books. Now, it makes sense for Tesla to continue to use this system to its advantage by receiving government help in the form of regulatory credits and diversify itself by investing in Bitcoin if it leads to the creation of additional shareholder value. As long as the company continues to increase its production and deliveries, its growth story will remain intact, and the stock can continue to appreciate in the near term. So Tesla kicked off this week's earnings by announcing that in Q1, it reached the highest production and delivery levels in its history. From January to March, the company's production increased by 76% year over year to 180,000 cars, while its deliveries increased 109% year over year to 185,000 cars. As for sales, Tesla's Q1 revenue increased 74% year on year to $10.4 billion, above the consensus by $110 million, while the automotive revenues increased 75% year on year to $9 billion. The company received $518 million in regulatory credits, the highest in its history, and its automotive gross margin of 26.5% was above its estimates of 24%. The recent quarter was also its seventh straight quarter of profits, as Tesla's GAAP EPS was 39 cents, while its GAAP net income was $438 million. The company managed to generate $239 million in free cash flow and increased its supercharger stations by 41% year on year to 2,700. Now, considering all those numbers, it's safe to say that Tesla had a decent performance during the quarter, as it was able to drive growth amid the Chinese New Year, the global chip shortages, and the shutdown of its Fremont factory in March for a couple days. Despite those challenges, the company also reached another major milestone, as its Model 3 became the best-selling premium sedan in the world, beating its ICE competitors by a very small margin, even though the production of the car started less than 4 years ago. As the demand for electric vehicles continue to grow at enormous speed, Tesla's goal in the upcoming months would be to significantly ramp up its production in order to solidify its position as a major EV manufacturer around the globe. The company already moved the production of its batteries in-house in order to quicken the process of developing cars, while other legacy automakers so far only managed to invest in joint ventures for battery supply. On top of that, Tesla already has capacity to build 1 million cars in a year across its Fremont and Shanghai gigafactories, and it will be able to increase it even more once its Berlin and Texas gigafactories are completed later this year. Another positive thing about Tesla is that it's on track to deliver 300,000 cars to the Chinese market in 2021, which is more than double from 137,000 that it delivered to the region in 2020. This goal will be achieved by ramping up the production of its Chinese-made Model Y from Shanghai Gigafactory. On top of that, it's also safe to assume that Tesla will be able to establish an even stronger presence in the region in the near term by producing a new $25,000 car, which according to some reports, should enter the market by next year. Tesla will also be able to increase sales by decreasing shipping costs once all of its factories are operational, as the growth in its recent years are achieved by the reduction of the average price of its car from $84,000 in 2017 to $38,000 now. Considering this, it's safe to assume that the company will have no problem reaching its long-term goal of increasing its deliveries on average by 50% every year once all of its factories are fully operational later this year. However, there are several risks that investors still need to consider. First of all, due to the German bureaucracy, Tesla's Berlin Gigafactory was delayed by a few months, which gave European manufacturers more time to expand their presence within the region. Considering this, it's crucial that the Gigafactory in Berlin becomes operational in the next few months in order for Tesla to get rid of its shipping costs and make its cars more affordable for Europeans. In addition, there's also risk in the long term Tesla might lose its market share in China due to the rise of competition and the pressure from the CCP. Since China has the biggest EV market in the world, it's no surprise that it has the most amount of electric vehicle startups among other nations. While most of them will fail in the long run, a handful of few such as XPeng, NIO, BYD Auto, Li Automotive, Geely, and others will be able to capture a significant amount of market share and establish a stronger presence by receiving help from local governments. On top of that, if hostilities between China and the US resume, then there's a risk that the local government could disrupt Tesla's operations by stealing its IP, borrowing its cars from its highways, or arresting its top management. However, I don't believe that's going to happen. The reality is that China wants to become carbon neutral by 2060, and Tesla is one of the many companies that will help it achieve its goal. Therefore, while political risks are very real, they're not a major threat in the near term. As for Tesla's valuation, at a 2022 price to sales ratio of around 10, I don't believe that the company is extremely overvalued as many might think. At the end of Q1, Tesla had $17.1 billion in cash reserves, so it's safe to assume that the company has enough money to fund its operations and increase the number of its deliveries, while in the end usually leads to the appreciation of its stock. On top of that, by holding Bitcoin, Tesla can hedge itself against its future possible losses of its core business, since it can easily sell some portion of its holdings to improve the overall performance as it did in Q1. By receiving a record $518 million in regulatory credits in Q1, it's safe to assume that the adoption of EVs by legacy automakers is not as fast as some might think. Therefore, there's every reason to believe that Tesla will continue to use this benefit from the government's help and will use the system to its advantage to create additional shareholder value along the way. Last up on the list, we have Twitter, ticker symbol TWTR. After really strong user growth due to the Rona last year, Twitter faces some really tough comps this year. Last Friday, Twitter stock fell around 15% due to monetizable daily active user growth in Q1 that missed analyst targets. The major focus of Twitter is always user growth. The social media platform has a fraction of its user base of Facebook, which provides substantial upside growth potential for the years ahead. The problem with the Q1 monetizable daily active users is that the tough comps from the first half of last year. The pulled forward users make it tough for Twitter to grow substantially from here. Regardless, the social media platform added 7 million DAUs in the quarter. The company grew 20% year over year after logging 17 million sequential user growth last quarter. In addition, Twitter returned to solid growth after a few quarters of stagnating user growth, but analysts had forecasted 8 million sequential DAU gains, causing a major disappointment to the stock market. While this miss is actually far from disappointing, the revenues didn't even miss. For Q1, Twitter reported revenues of $1.04 billion, which was slightly above analyst expectations. Now, unfortunately, a lot of tech companies blew away their Q1 estimates, so the lack of a major beat was a pretty big disappointment. Facebook reported a $2.46 billion revenue beat and grew revenues by 47.5% in the last quarter. In fact, this Facebook beat was nearly 2.5 times the quarterly revenue of Twitter. The one spot that was definitely disappointing was the Q2 revenue guidance. Twitter forecasted Q2 revenues of $989 million to around $1.08 billion, slightly below the $1.05 billion consensus in guidance for flat sequential revenues. The company is still struggling to monetize its user base to a higher degree. Twitter has a goal of doubling revenues by 2023 to $7.5 billion, and a lot of the excitement around the stock is related to subscription offerings. The review, acquisition, and the launch of Spaces, along with exploring premium options on the Twitter platform, set the company up for products to move beyond advertising revenues. Despite the goal of its social media platform, the analyst group still hasn't even forecast Twitter approaching the $7.5 billion revenue target for 2023. The company continues to hold this target despite what the market sees as disappointing Q1 metrics and Q2 guidance. Analysts have revenues growing at around 28%, 23%, and 21% over the next 3 years to reach just the $7.1 billion revenue target in 2023. Twitter isn't necessarily forecasting explosive growth, but the market doesn't appear convinced here. After the stock had fallen 15% following the Q1 results, Twitter is turning back into a value play in the social media space. Snap currently trades at a forward enterprise value to sales multiple of 16 times, while Pinterest is nearly at 12 times, even after falling drastically after its Q1 earnings. Twitter will be closer to 7 times after the sell-off, leaving the stock close to the multiple of Facebook, which has a 6 times multiple. The biggest question is whether or not Twitter can actually sustain the 20% revenue growth going forward. Twitter is reliant on brand advertisers, and the quarter still has many delayed or canceled events as COVID-19 was rampant around the world through January and February. In addition, the company has only recently implemented new ad programs. Twitter is a far different business now, with nearly 200 million monetizable daily active users after entering 2020 with only around 145 million. The platform now is poised to continue consistent user growth despite some tough comps in the next couple quarters. If the company can still grow users at this rate, the future is bright when Twitter moves beyond the shutdown-induced user surge. The social media platform has a goal of reaching 315 million daily active users by 2023, and just 20% user growth in 2022 and 2023 reaches this target. The biggest question remains on its revenue side, where Twitter has long struggled. Any ARPU growth over the next few years will lead to substantial revenue growth as users expand. I believe the key takeaway is the social media company has plenty of catalysts for revenue growth going forward, and investors shouldn't extrapolate too much on its Q1 growth. So that was my breakdown of 5 growth stocks that are down after its recent earnings in the past week that Ark Invest have been buying. So of course, you're probably wondering what stocks I like the best out of the ones I talked about today. So I thought it'd be fun if I went ahead and just ranked them on a list, and then you guys can go ahead and use that against your list or just see what stocks that I'm most interested in. So my thought process when categorizing this list is really what stock has the most upside potential. As some of you know, I'm a big Tesla bull. However, I don't think the upside is quite as high as some of these other stocks. So it's not to say that I don't think Tesla is a better company. It's just that some of these other picks might have a much better upside given their current market cap. So first on my list, I have Teledoc Health. Now, the main reason I put Teledoc first on this list is not only because they're seeing very impressive revenue growth at a 150% growth rate, but I believe the merger with Livongo really sets up Teledoc to become the leader within the space and to own the majority market share within this fast-growing industry. Virtual healthcare has a huge total addressable market with a lot of tailwinds behind them, and I believe Teledoc is well positioned to continue to gain majority market share of this whole entire industry. Now, second up on my list is Pinterest. Now, I have no current holdings in Pinterest. However, it's been a stock that I've been wanting to get into for a while now. Pinterest is seeing very robust revenue growth. It has just seen profitability in its last few quarters, and it's guiding to over 100% revenue growth for next quarter. Now, I believe a lot of bears will point towards the slowing monthly active user growth. However, I believe this is widely misunderstood in that Pinterest should focus more on its monetization opportunities and more on user engagement. Now, Pinterest currently sits around a $45 billion market cap. And although that is pretty lofty, I still believe there's a lot of upside to Pinterest. Pinterest is still producing outstanding revenue growth, and the opportunities for sustaining both engagement and monetization is very exciting for both their advertising and for the e-commerce business. Next, I have Tesla on this list. And I don't think there's any need for any explanation when it comes to Tesla. They have a lot of huge tailwinds behind them. They're the leader in the EV space. And honestly, Elon Musk is a genius. So taking a bet on Tesla is really taking a bet on Elon Musk. I do believe there's still good upside to Tesla. However, given its current valuation and market cap, I do believe that there are better opportunities out there for potential multi-baggers. Next up, we have Twitter. Now, I believe Twitter is a lot more of a safe play. I don't believe there's that much upside to it because its revenue growth is only around 26%, but they are profitable. They are still seeing monthly active user growth. And given recent product announcements centered around Twitter Spaces, which is a live audio feature, I believe user growth could actually be in the future and in turn would help boost up Twitter stock price as well. And last up, we have Spotify. Now, I'm a happy user of Spotify, and I've been using Spotify Premium for about 4 or 5 years now. I genuinely love the product, and I think Spotify is making a lot of the right moves within the audio space by investing into podcasts, trying to break into audiobooks, and building out their podcast network. Now, Spotify is seeing over 15% revenue growth and 24% growth in their monthly active users year over year, so they're definitely no slouch. They're definitely still growing at a pretty decent rate. Spotify actually squeaked out a profit for the first time last quarter, which is a really good sign. However, the reason I'm not investing in Spotify is really just in the nature of this business. It's a very low margin business, and it's been seen, although Spotify has been in business for about 15 years or more, they still can barely turn a profit. And that's really just because of the licensing nature of this music streaming industry. Now, of course, Spotify can really tap into really becoming the audio center for the world. However, I believe they're still just in the early innings of that. So to me, I would rather put my money elsewhere as opposed to this slow grower that still needs time to prove itself to really become the audio giant within the world. So those are my thoughts on 5 growth stocks that recently reported earnings last week that actually took a tumble and that Ark Invest have been buying. I would be happy to add any of these stocks to my portfolio. However, just based off of my list, you can see what stocks I'm leaning more towards adding. So with that, guys, don't forget to check out the Patreon if you guys want to support the show and also get more real-time updates. Don't forget to smash that like button if you're watching this on YouTube. Go ahead and hit that subscribe button. And if you're listening to this on the pod, don't forget to leave me that 5 stars on Apple Podcast. With that, guys, thanks as always. I'll see you in the next one, and let's go get that bag.